Hey everyone, my name is Sean and welcome to Invest with Fire. In this video, we're going to talk about mutual fund fees and how these fees are basically robbing you. Before I dive into it, and if you're new here and want to continue to get investing videos to help you grow your wealth, consider subscribing to the channel to join us. If you're invested in mutual funds, the number one thing you can do is really make sure to pay attention to the fees. What you need to understand is that mutual funds are set up to benefit the mutual fund company and not you. The mutual fund is set up to pay their CEO, their admin, their marketing team. Your mutual fund manager will downplay these fees because the fees look small, right? The fees may range from 1% to 2%. But in actuality, the system is set up to take half to 2/3 of your money. But this will depend on how much money you have invested and how long your fund is invested with them. So how is this possible? It's possible because when your fund reaches a large amount, 2% will really add up. So for example, if you had $1 million and you just take 2% off that, that's $20,000. And if you have a couple years of just taking $20,000 from you, that's really going to add up and help fund the mutual fund manager and not you. And even if your account goes down in value, they're still going to take that 2% fee. Let's look at another example. Let's say Jenny puts $1,000 into a 401k account at age 20 and keeps adding $1,000 a year until she's 85. The money is invested in some kind of broad market mutual fund, and the fund performs in the top 30% of all funds and gets a rate of return that matches S&P 500, which for the last 100 years is about 8%. And let's say her fund carries some normal fees such as management fee of 1% and her marketing fee of 0.5%. and admin fees of 0.5%. If we put all these numbers into a calculator, she'll accumulate about $806,000 in a retirement account. Woohoo! Except, what she doesn't realize is that if she didn't pay that tiny little fee, she would have $2.1 million in her account. Same market, same investment, but the fees ripped her off $2.1 million from her. However, it does take time for the fees to add up and drag the return down. So what exactly are these fees paying for? They're paying for active management fees. That may sound really fancy, and they're gonna explain it as like, we're managing your funds and watching the markets. Oh, we're changing up the investment style based on the market. But in actuality, a lot of these fund managers really just can't beat the market. So what they're doing is just basically matching the index and copying it. They're just saying, oh, we're doing all these things, but in actuality, they're just copying the index fund. And they're really not doing much, especially when you add on top of these fees that really drag down your returns. So what exactly are these active management fees paying for? These fees are really paying for their bonuses, they're paying for the administration, they're paying for the marketing team, they're paying for lunches, they're paying for outings, they're paying for the kids' tuition. But ultimately, what these fees are paying for is a big propaganda machine. And that machine is tricking you into thinking that you can't manage your own money and you should trust us because we're a large company and we're gonna properly manage your money right. Because look at us, we have this huge building. But in actuality, those fees paid for that building to convince you to think that those fund managers can actually properly manage your money. When all in the end, you could have just put that money into an index fund with a very low fee and came up on top of these mutual funds. And the funny thing is that these mutual funds are not even in the investing business. They are in the assets under management game. What this game is about is collecting more assets, because the more assets you get, the more money you're gonna get when you take or sell the fund to public. These fund managers are getting like a 20% cut of every dollar that they raised. And gathering assets requires heavy spending on advertising and marketing to sell the dream. But there's nothing in there about delivering on the promises that they make. They're targeting people that don't have a financial education. And they're looking for people who are ignorant and are looking for a place to put their money in investments who don't know how the game is played. And that's why I created this channel, to help people and educate them about investing. So what can we do about it? The first thing you can do, of course, is pay attention to the mutual fund fees and try to find a fee that matches the SPY with the lowest possible fee that you can. The second thing you can do is that if your mutual fund doesn't have an index like SPY, then you should demand it. You should make a big stink about it, get your coworkers riled up, and make sure that they understand, the fees that are involved in their mutual funds. And everyone just needs to get on board and demand it. The third thing you can do is diversify. Take some of that money that you would have put in your 401k and invest in individual stocks. But this is going to require more work because you need to research a company and keep up with the company. Of course, this depends on your risk profile and what you're comfortable with. Make sure to pay attention to your mutual fund fees. While 1 or 2% may seem like a small amount, it really adds up, especially when your account grows bigger and bigger. If you can, move to another index fund that has very low fees, like SPY if you can. So I hope everyone has a great day. Take care, investors. See ya.